Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Geoff, how's it going?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you are tuning in, you're not going to know what I'm going to say. If this is not the first time tuning in, you are going to know what I'm going to say. Be sure to go to quickfs.net. Be sure to sign up. Tell them that you came from Focus Compounding. It helps support everything that we do on the podcast. It's the software that Geoff and I use every single day to pull long-term financial data, 20 years. And it's just a great website. It's quick, hence the name QuickFS. If you do sign up, like I said, tell them you came from Focus Compounding. So in today's podcast, we are going to be doing a Q&A. This is the episode where we connect with our listeners and get to answer questions that are on their minds. To be able to ask a question of that in the future, follow me at Focus Compound. I'll put all the information down in the description below. The first question, he says, Berkshire Buybacks. So any thoughts on Berkshire Buybacks? And then he says Facebook or Meta. That's their name now, Meta. Okay. Losing the ad battle and what that means for Google. Any thoughts on Berkshire?
You want to take that question?
I don't have anything on Facebook or Meta.
Okay.
What's that one show that you really like? The advertising show?
Mad Men?
Yeah, Mad Men. So when Facebook did this, when they came out with their name Meta for like Metaverse, there was a meme that was going around that was really funny. It was of the actor from Mad Men.
Okay.
And he's like pitching. He's like, I'm going to give you the best name ever for the Metaverse. And he was like, Meta. And I thought it was so funny. But I have no opinion on Facebook or the Metaverse. I have kind of learned a little bit about Web3. I think I'm going to get ahead of the curve and start to learn about Web 4.
Okay.
But no, I have no thoughts on that other than, Facebook's going to be spending, what is it, $10 billion a year, something crazy, a lot of capital to be doing that. And clearly Mark Zuckerberg very much believes in the Metaverse. And I don't have any thoughts though on that.
How much is that relative to what they earn now?
Let's see. I think it's $10 billion a year, I believe is what the number was. But you could look at the cash flow statement. I mean,
it's a third or so.
Mm-hmm. So it's a pretty big bet. Yeah, for sure. A lot of people think Facebook's actually cheap. You know what company other people think is cheap?
I do know
Alibaba.
Alibaba, yeah.
Uh-huh. Yeah. But anyway, so I have no thoughts on Facebook or Metaverse. I don't even look at the company that much. I see it on Twitter and I've seen that Facebook's valuation looks probably a little bit more interesting than it usually does. But no, I have no thoughts on that. Google is, I'd rather own Google than Facebook. I think Google is just a cash machine. But any thoughts on Berkshire Buybacks? Is he going to buy back their stock? He's sitting on like how much capital? 120 billion, something crazy like that.
Well, where can we check Berkshire? How is this quick? How has to check Berkshire? Well, for at least a stock price.
Yeah.
Berkshire is difficult because of the two share classes and stuff. It sometimes throws off some online things. Yeah. And then what's Apple at? Just so because
like
that's a significant part.
Third of it or something like that.
Let's say. So Berkshire owns
it's like 25%.
150 billion, roughly, if that's the market cap, correct? Is that right?
Something like that.
Right around that of Apple, yeah.
I guess that old dog still has some tricks left in him, huh?
Yeah.
Here's the thing, and I've thought about this too. People talk about Berkshire. It's like him selling Apple. Is he going to sell Apple? There's no way he's going.
A little bit of Apple.
Yeah, but I don't think he's going to dump the whole position. I don't know why he did do that because that's very not like Buffett.
He's occasionally sold little bits of some stuff. Sometimes he sold completely out of Cap Cities, and he sold a little Cap Cities before Cap Cities and Disney merged. Yeah, he was selling a little bit of it, and apparently he's mentioned to people like allegedly before he bought out Geico, he had said to some Geico directors, "I might sell this stake," and he owned half the company. So he didn't like what was happening there. So I don't know. I don't know why he doesn't need the cash. I do wonder. I mean, I think it's a price thing is the only reason why he sold any. At the time was just looking at it from a price perspective. That's the only thing that I could see. I don't think he would do it for diversification purposes. Like I don't think he thought it had gotten too big. I do think it was probably a price thing. And he said that, Charlie wouldn't have done it.
Yeah. Well, in the letter too, the takeaway from it was that he thought Berkshire was cheap and that they were going to buy back their stock.
I think Berkshire is cheap relative to the market compared to many times in which Buffett has been in control of Berkshire and what he could do at times. Yeah, I do think that's true. Because at some other times when the market was kind of expensive and stuff, actually Berkshire was pretty expensive. So, Berkshire was, at the very end of the 90s, Berkshire was kind of cheap versus the S&P 500 and all that. But a few years before then, like 96, 97 or whatever, it wasn't very cheap. And actually in like the 87 period where he was a little worried about stocks, 87, 88, 89, Berkshire wasn't all that cheap either, probably. So I do think that like he has a lot of capital, and he probably thinks Berkshire's attractive versus other sorts of options. I mean, we've talked a little bit about that. You can see, so I mean, this is easy. You can, if you want to do a sum of the parts on Berkshire, you can see Apple. You can look that up yourself of what its market cap is at any time and all that. You can look at, say, Union Pacific, for example, is a pretty good comp for Burlington Northern, publicly traded. You can look at Progressive is a pretty good comp for Geico. So have an idea just from those things of adding that kind of stuff up, what, that might be worth. And then, there's not really there is no good comparison for Berkshire Hathaway Energy because it doesn't pay dividends. So it is completely different from other energy companies, other utilities. But the others have clear, Apple's publicly traded.
Yeah.
So you can see exactly what it is. And then Progressive Geico and Burlington Northern both have really good comparisons of what the market would value them at. I don't see a Buffett premium in terms of like if versus a sum of the parts at current market prices. I don't see that at all.
Do you think he'll buy back his stock?
Well, what did we say when we did our last Berkshire thing? I basically think I said that. Yeah.
He thinks it's cheap. Yeah. Somebody emailed in a question, so I'm not going to pull it up, but he said, have you and Geoff noticed any change in turnover / liquidity in the stocks you focus on with the increased retail / trading activity in the markets?
Not in the stocks that we normally invest in, right? I don't think so at all. What seems to be the most popular, I guess, more about the meme things, is something that is recognizable, but actually kind of limited float or whatever thing. So like the reverse of what we do. So it's more like the name, the idea of it, the thing it's in, whatever, is very catchy and well known, but then the stock actually is not huge, so that these things, the prices can move it. Whereas we tend to focus on things that actually are the reverse of that. Like they tend to be, for instance, have a name that doesn't give away what the actual business thing. That's my favorite one, which I've said many times. I love it when a company uses like a totally different name for what it does. They do, Berkshire Hathaway. People are like, "What is
realty
that?
company?"
Is that it? Yeah. So we mentioned Flanagan's, in a previous podcast. I just mentioned as an example of a restaurant thing. Flanagan's unfortunately does use its actual name, but if you notice, the ticker is BDL for Big Daddy's Liquor. So it's better if it would be a better stock if they use that name because that's a small part of the business. So it's always good when they use, something like that. Whereas, some of the others are, we just talked about movie theater things, right? And the one we didn't talk about is AMC. That's the one we didn't look at. I talked about Marcus, so.
And then he asks, other than banks / financials, do any other sectors look as cheap as they did during the great value hunting bin of 2001 or of 2000 to 2001?
No. And banks don't look as cheap as they did. In terms of the sorts of things that I was buying then, no, nothing is anywhere near that. It's remarkable how expensive everything is as compared to that sort of thing. I don't see the same split in the market that I did then, unfortunately. That's why now is harder for me than in the .com years. The .com years were actually not hard. Value, it was really good to be a value investor. Your performance might have not been great. Certainly some value funds performance wasn't great, but you were very happy about what you were buying and you weren't worried at all about the prices. In some ways, maybe that was frustrating for them, that they're buying good businesses at 5, 6, 7, 8 times PE, and they're not getting any recognition for that. But I don't see that as the case today at all. Generally, even the boring old business ones are kind of cheap. It's not as cheap as then, but the one we don't talk about, just because we don't talk about it that much, is energy like fossil fuels. that is maybe has been recently sometimes kind of looking cheap in the same way as bank things, had before. Cyclical, but if you sort of think that there's maybe not going to be as much over investment as there was in the past, then maybe those things are attractive to people. But I don't know enough about that. But like if people knew a lot about energy things, some of them might think that some fossil fuel things are cheap. Yeah.
Trey asks from DIY Investing, when are you launching a SPAC and why will it be called #Jeff? No plans for a SPAC, Jeff?
No plans for a SPAC. I was reading Predator's Ball. Is that what it's called? That's what the event was called. The Michael Milken and all those sorts of things, John Bond things, and all the different financial engineering of that.
I've been reading Den of Thieves.
Okay.
Yeah.
So it's interesting reading about Nelson Peltz and Carl Icahn and all those sorts of things. It just reminding me about SPACs because it also gets a little bit into what happened in the 60s, which was the thing. I think Buffett talked about that. The 60s with the letter stock and everything is the most similar to the SPAC period. That was very strange. There was a brief period in the 60s of the conglomerate sort of thing where you issued to take over companies and you would just be doing all this issuing of various different securities that you would do that were kind of strange. And it reminded me of SPACs that way. All these warrants and interest in different companies that you then used to acquire. That's how Teledyne sort of got started. It was one of those kind of weird conglomerates.
How bearish is Jeff now?
I don't know about bearish, right? We don't talk about that. Like I don't predict the future of the market or try to call when something's too high or whatever. But it's difficult to find things that are cheap. And I think it's the hardest that it's been.
Our definition of cheap. Because you could see a lot of companies, I think, that have come down in price. But they still, if you're looking at a stock chart, people,
I don't look at a stock chart. I look at the
but
price,
our version of how we think about cheapness.
You can see how much you can look at your own portfolio. Anyone listening to this, if your portfolio went up this year more than the earnings of the companies that you own, compare those two. What was the look-through earnings of the companies and what was the price performance? You kind of pulled forward some future performance to today. That's what that means. I always look through at what the earnings are and if they're growing and that sort of thing. And so even if your earnings grew at 10, 15% this year, you pulled forward a lot of performance because your portfolio is probably up more than that. So I was pretty down, and you can read some of the blog posts and things. I sound pretty down if you read my feelings in 2007 to the end of 2006 to the first half of 2007 or something. Stock prices weren't really coming down in any sorts of things yet, but the prices were not across the board kind of a little expensive. That period was harder for me than 2006, 2007 was harder than .com. Even though the stock market was not as high, it was more broadly expensive. And it's like that now, where it's difficult because you look at anything that you like, and a lot of times you look at things that have some problems and they seem priced normally, I would say. We talked about that with the movie theaters and stuff. Are they attractive versus other stocks? They might be, but we know that they at best are about break even right now. They've just gone through basically 2 years of being shut down, borrowing, all that. And they're priced kind of like a normal stock in normal times would be. Now that might be cheap for today, but if we showed someone this price said to them in the 1990s, in 2020, this is what the PE on this will be and stuff, for their normal earnings, they'd say, I guess things are going normal. It was a normal year for the movie industry,
He asks, what are your thoughts on ABG? You could pull that up right now on our favorite website. Have you looked at this company before?
Yeah, I don't really have thoughts, I think. So
it's a dealership. Offers a range of automotive products and services, including new and used vehicles and vehicle repair and maintenance services.
Yeah, so where do they have? They have the headquarters. They have, let's see what they have.
Headquartered in Duluth, Georgia.
Right. So here's the thing. I'm many of these companies, there's other ones too, are probably attractive in some ways. I had made the decision to invest in a UK car dealer instead of US.
Why was that?
I thought they were really cheap versus the US. And we could get in, I think some people felt, I think other people felt there was more of a difference between the UK and US than I did. I felt a lot of what people were attributing to like more permanent market factor type things actually had to do with capital allocation and scale, that there was less scale among the UK car dealers compared to the ones they're comparing them to in the US. And that the financial engineering was different, that the capital allocation was different. So I felt if you could get a UK car dealer that was going to have decent capital allocation going forward, at least, or better than decent, then you'd have a good investment. And so I thought they were a lot cheaper. Some of them have gone up though. Cambria was bought out, went up and was bought out. Virtu's gone up, so
significantly.
Yeah. I mean, some of the things we're talking about have doubled or something. So so basically it's basically around, what's the 1 year on year to date you could use? I guess 1 year it's
127% year to date, 94%, 95%.
Yeah. So we didn't buy it at this price, I guess is what I want to caution when you're looking at it. But and that maybe the gap between the UK and US car dealers is not as big as it was. If you go there to QuickFS, that tab. Yeah. So I know the numbers for Virtu, so you can type in the other one, Asbury, that ticker, so we can kind of give an idea of this. So this is price to book, whereas I'm looking at price to tangible book and stuff like that normally. So, the EV to EBITDA, so like you're seeing the EV to EBITDA on this is looking at, I don't know if this is so on current year, 2020, if this is correct, we're talking about like 7 times EV to EBITDA. You could buy UK ones at 3 to 4. And I thought it was that EBITDA was not like peak EBITDA. That wasn't 2020 EBITDA. It was when I was looking at it over the EBITDA they'd had in the last 2 or 3 years, and routinely they were available at 3 or 4 times. And then there was also financing things to get into, like Virtu had not financed as much, wasn't leasing as much of their properties, wasn't borrowing as much against their inventory as I think that you could be in that industry. So that was part of the thing that I thought was attractive, because then you get a lot of, if you sell things, you get a lot of cash flow from them. Or if you decide that you need to do an acquisition or something, you can borrow to do that. But I think some of it obviously has been recognized because look, Virtu's up a bunch of the stock. Cambria, the management bought them out, bought out the minority shareholders. So obviously there's some recognition.
I was going to say,
in that industry.
If management's buying out your company, there's a reason for that. And
they raised it too, to close that deal and stuff. I mean, they altered the way that the deal was set up. So, so look, not up as much, right, in the last year. Year to date, so the gap has closed somewhat. And I would say that the earnings that you're seeing right now in the UK ones, certainly Virtu, are abnormal. And on like a price to tangible book type basis where I'd look at it, this is not where we would buy in at today's price. But there is sort of a one-time strong earnings thing that throws off the calculation, But absent that, I wouldn't be buying in at today's prices at that level. So, but I do like car dealers as a business overall. And so if you're going to buy US stocks then it would be an area I would look at, definitely. And I think the capital allocation has been better among US car dealers, publicly traded ones, than UK.
Next question. How do you grade / think about company culture? How important is it for long-term results? What kind of management behavior do you dislike the most? Have any favorites? ?
Okay. Do you want to start?
I would say that we think about company culture often. I would say it's very important. I would say a company that has a culture of being very cost conscious. We've talked about this a lot, how, if at the top management is very cost conscious and it's something that's kind of ingrained in their culture, that kind of trickles down to lower level employees. How do you grade it? Well, you could talk to management, you could go see the place, you could talk to employees that left the company. There's other websites and stuff, just really talking to people. But no, I would say it's very important. But for me, I really like a culture that is very cost conscious. probably doesn't care too much about their stock. I wouldn't feel too comfortable if I walked into Enron, for example, and tickers are everywhere, right? Like they make decisions based solely on what the market thinks or stuff like that. But I would say for me, really cost consciousness is a huge thing. And then Geoff, we've actually talked about too, just how information spreads throughout the company or how things get done, right? Our biggest fear is always if you work at a company, you tell a manager or somebody below you to do something, you don't follow up on it and it just never gets done, right? So some companies, there's just so many layers upon layers upon layers where it's like nothing actually gets done. So flat organizations, I mean, you look at Berkshire, right? We just had that up there. The size of that company and how many people do they have at their headquarters?
Right.
30 people, something like that. But for me, something that always stands out is just very cost conscious. And that could come a lot by the type of companies that we look at. But I would say, generally speaking, that's something that always stands out to me, right? I mean, we've always talked about banking, for example, how we like one branch banks, right? They're super focused on costs. Money's a commodity. One thing you can control is the expense item on the income statement. So that's probably something I think a lot about. What about you?
Yeah, I mean, we like it when management thinks like an owner, either because they are an owner or that's how they were trained to think or whatever it might be. But that's the common answer for all value investors, right? It was the capital allocation. That's not really the managing of the business. I'd say cost conscious, like you said, is probably number one. Or along with that, actually, there's kind of three that are right alongside it, which is, cost conscious to me, not letting the costs in the first place, more so than cutting them, is like not letting them start in the first place, not letting the weeds grow at all. And then probably really small circle of competence, like just to focus on a view of they don't think that they can or should do what they're maybe not is not the best thing for them to attempt. So if they have a niche that's working, they're not going to get distracted and move away from that. You were talking about advertising things, Mad Men, stuff like that. The biggest mistake in advertising, usually from the client perspective, seems to be they get fed up with an ad campaign that's working before other people do. It would be, a lot of managements would say, well, I'm tired of this gecko.
Yeah,
let's get him off the air. They have to convince him it's still working, so just stick with what's working if it is working. And then the other one, which is what you were saying, is however you want to call it, the initiative, the toughness of will or whatever it is to get things done, or the ability to communicate in their culture with that. For a lot of things, a lot of times there's good intentions that aren't going to be put into action or won't be put into action fast enough. So management may be telling you something that's absolutely true for them, but several layers down the organization, that's not how things are actually run. And as organizations get bigger, that becomes harder. It's easier with really small companies because often what management is telling us is and what we see at the top levels is more indicative of the overall organization. Whereas the influence you can have at a really big company is sometimes different. And in a lot of ways, I think culture is probably more important at a big company usually than management.
Yeah. But another source too is you could go to glassdoor.com and really kind of get a feel for what employees think. But it's different though too, right? I mean, if we were investing in Amazon, we would probably like the big bold bets and fail often, fail hard. If you're not failing enough, then you're not trying enough. It seems like that's what the culture is like there, where they just really encourage people to make very bold bets and try to innovate and stuff like that. So I would say it's a little bit different from our perspective based on the companies that we're looking at. But yeah.
Oh, I like experiments.
Of course, we like experiments. Yeah.
Yeah. No, but relative to Amazon shuts those things. Usually, Amazon has shut things down pretty fast when they failed. They haven't stuck it out with losing a lot of money in something that their results don't look good for them. It's good to try in a way that doesn't risk taking down the whole organization. For that kind of company, Amazon actually hasn't been terribly reckless about its financial situation or anything in their history, really.
Next question. You have often spoken highly of GRBK, Green Brick Partners. What has made you resist pulling the trigger? Is it purely based on the valuation, or do you avoid this industry?
Some of it's valuation, I guess. I think a lot of it is a speculation on land prices and things like that. What do we look at this at $6 or something at one time? So, I mean, maybe you could answer better. We live in the area where they do a lot of business.
Here, Colorado. Where else are they? I forget that last market that they're in.
Is it the Atlanta market?
Atlanta, yeah. So it's like, very hot metro, areas. But Green Brick Partners, I mean, it's very popular around the DFW area.
Right, we can see some of the things they're building.
Yeah, absolutely. And Green Bricks, or Jim Brickman, he's been a builder for a very long time. And then he partnered with David Einhorn, which is probably how a lot more people know about the company now. It's a larger position for him. But I don't know. I mean, we try to stay away from very cyclical things, I would say. And even if they have a unique business model, or NVR has a unique business model, I do think it's still attached to an industry that is proven to be pretty cyclical. I do think it's probably a cheap company. I will tell you that much, but I just don't think it's something that we would buy.
If you look at the balance sheet, we could see so balance sheet, and then we could go quarterly just to make sure that I'm seeing the most recent. Okay, we have inventories. Let's see, do they list that for us?
1.1 billion.
1.1 billion. Okay, and then what's the market cap on the stock? They also have debt, but we won't worry about that right now. The market cap on the stock is
1.6 billion.
Yeah,
it's really gone up.
I mean,
to me, it just didn't seem like something we would buy. There's a lot of times I come across companies, I'm like, I could see how that stock could work out. I could see how that business would work out. But just kind of, if I had to lay out like a blueprint of the quintessential business that we'd be interested in, it just kind of didn't seem like that to me.
If it was trading at close to book value, and I thought buying a home in the DFW area was a good investment, I wouldn't rule out investing in this company. I like this company fine. But, I look at it from the asset perspective. I don't think that this home builder or many others are really all that cheap versus the assets. And I think that a lot of your return depends on that in the long run. Because I think we've talked about this. For the most part, what a company like this does is they make money. And yes, it's earnings, but those earnings are then put back into land, which is not what NVR does, but it is what they're doing. So that land, I mean, if you go to the balance sheet, this might help people just so we can go, let's do annual instead of quarterly. So you understand what I'm saying here. So if we look at inventories, right?
Yep.
All right. So what are we seeing in terms of the trend over time there? Where do we start?
Yeah, it's gone up. I mean, right. So like 2014, 275 million. I think that's probably right around when, because this was a shell. Okay. So they did like a reverse merger.
So let's say when we were looking at it then, let's say, maybe it was 400, it's 400 to 500 range or something like that. It's now at over double that. Right, because we just did the quarterly one is 1 point some billion. That is really, I would say, what you're betting on. I mean, you can look at what retained earnings are and all that. What you get your payment in form of more and more land. Is basically what I'm saying. And so it's a continual speculation on land, which isn't necessarily a bad thing. And we just talked about inflation and stuff. It could be a good thing. It may be getting in land is better than most ways in which you would make money, but it is something that I'm very aware of that way. I would see it differently than if it was cash that was paid out to me in dividends and stuff like that. Yeah. I'm not sure that land is particularly cheap and attractive as an investment versus some other things we might do. It's leveraged up though. I mean, obviously, and then it makes money as a home builder. So that's always the part that this kind of home builder versus NVR that's always been an issue for me in thinking about it. Is I do feel it has to be cheap on an asset basis. That's what I'd like it to be, because you are going to be paid in more and more land that they're buying at market prices, basically.
Do you have an update on NACO?
In what sense? I don't know.
He just asked for an update on NACO.
No, I don't have an update on NACO. You're on the quarterly calls. Yeah, they can hear you, read you in the transcript.
That's right.
There've actually been other people recently
It's
have
actually been pretty surprising to me, but yes.
Yeah. So when we started out, you were always the only one asking questions. So yeah. So if you get some ideas of our thinking on NACO, usually it would be what questions is Andrew asking on the quarterly earnings call, which they do. It's actually for a company that level of their profile generally, low profile. It's, a real, they're on the earnings call with the CEOs there, and it goes on for a while and everything. So that's the way to get updates on it.
Okay. Do you have any thoughts on sports teams / sports franchises as a business? Are they good businesses? Thanks.
They've made some people very wealthy. They are a monopoly.
Yeah.
Yeah.
Regional monopoly. There you go.
Yeah.
What did Mark Cuban buy the Mavs for? I think a couple $100 million. He thinks they're worth a couple billion now. Yeah, they've been great assets for people, for sure.
Yeah, they've definitely been good assets for people. I don't know about the prices that they sell at, and if you make a lot of money from them in general, in terms of actually generating cash, you'll be hated in your local community, because if they find out that you pocketed $20 million of earnings instead of having a $220 million payroll instead of a 200 in baseball or something, then you'll be hated in that city and stuff, because they expect you to run the team for the benefit of the fans, not as the owner,
not as a business.
Yeah, it's not expected as a business. And I don't know about the sense of the prices that we're talking about. Yeah, so I don't know as an investment. Certainly, let's say as an example, NFL franchise has been a good investment for the last 40 years or so. Yeah.
Here's an interesting question. If you had to invest in a company for the next 50 years, would you rather invest in a company with high margins or consistent low margins? High margins attracting more competition versus low margin making it nearly impossible unless it is run well. He said, for example, Costco.
Yeah, definitely high margins. 100% high margins. I don't know if Costco will be around in 50 years. I don't know if Amazon will be around in 50 years. I suspect that they have, so much capital and everything over time that they will be around in some form. But I think it's a very tough business, very competitive. Retailers do not fail, except by going to zero, basically. Retail is not a business that I generally want to be invested in, even with the lowest cost that way. And so that, a low cost retailer can be very successful as long as the culture is run that way and stuff. But that's true for other things. I mean, if I was going to buy an airline, years ago and stuff, I would buy Southwest. But I would also know that odds are the culture will change over time. There'll be different factors that come in, and you'll lose that low cost. It's very execution dependent.
It's hard though. Think how much Berkshire's changed over the past 50 years. Like, what is Berkshire now? Berkshire Hathaway Energy, Apple,
right? But that's what I mean. So
insurance, Geico. It's like 4 companies.
It generated cash flow that then put into all sorts of other things.
That's what I'm saying. But investing some for the next 50 years, just one company forever. Yeah.
Right. Yeah. You want to own. Well, I gave the example of Disney, for instance. You want to own something in which you have a feeling that the capital will be allocated in entertainment, in food, consumer brands, those sorts of things, because those investments, it will survive, and those investments will not be destroy all the value. Retailers will go to. I mean, I would rather, if I had to own something for 50 years. This will horrify people, but I would rather own Activision than Costco. Yeah. It's just it's in a safer industry. It can have not very smart people running it and stuff. Costco, if you don't maintain the culture that you have, if you don't have the right people running it, can really run into trouble. I mean, Disney was run by incompetent people many times in its history.
Yeah.
Many times.
Read
so
the book
Coke,
Disney Wars.
Coca-Cola. And that wasn't the most incompetent. That was after the most incompetent period. Costco can't afford that. High margins. Yeah. And that's even like with giant companies that we're talking about. If it was smaller sorts of things, even, brands, things with mind share. Like I said, I would rather, of like say the things that Berkshire owns, right? They own these great different businesses and stuff. I would rather own, let's say, C's than a lot of other things that they have if I had to own it for all that time. Yeah.
Geoff has always said his forever company, if he could only pick one for the rest of his life, would be Disney.
I think, yeah, I mean, some things do change over time, ways of distributing things and whatever. And so there are businesses that fail over time from these categories, but it is the things that are in, whether it's media things, food things, stuff like that, that have a lot, if they have a mind share, like we're talking about over time and stuff. If you're just an outlet for some stuff, I don't know. But I would definitely rather be in those things than in retail. In retail, you're effectively, what Costco's offering is not Costco. It's the things that they're selling at a certain price, which is fine as long as you can maintain that. We have this discussion all the time with some companies that we own. And you ask me which is my favorite and whichever things. And sometimes something that we own a lot of and stuff, you ask like, what's the best business? And some things we own a lot of, I'd say it's not the one that I would go to a desert island with, because if it didn't have this management and it didn't have this culture, then I wouldn't feel comfortable with it. So then the same thing I've said with like financial things, when people are like, what would you own, forever? I can't really answer a bank or an insurer because I would need to know who's running it and stuff. You can see what happened to Geico. Geico always had a low cost advantage, but it ran itself into the ground. Coke was as incompetently run at that same period. 1970s, Coke was not being run very well. And the stock was crazy expensive and everything. It never ran into the sorts of problems that Geico did very quickly. So yeah, but low cost is a great thing for a long time, as long as the execution is there, which is management, culture, all those things, and you have to watch it. I think they're great stocks. I think Costco is a great stock, but you can't buy it and then forget about it. Yeah.
We could do last question and we'll continue with this thread next week. Somebody says, as a small fund, who are your favorite investors to source ideas from?
So let's see. They mean like actual other investors?
I guess so. Yeah.
I really don't get ideas like from published. Yeah. They're too big.
Yeah.
They invest too much in things that are better known. I mean, my preference, is to own things that are more overlooked and all of that. That's why we do it.
And everyone we're just playing our own game. That doesn't mean it's the right way. But I would say there's rarely, I can't think of any situation where we've been in a company with some other, I would say, well-known fund also involved. Maybe one, but it's not, I don't think that's not something that's normal for us. We don't really take ideas from other people, I would say.
Yeah, I'd say that's true. I do watch what other people do. Sometimes I like to see what the portfolios look like and whether they're doing something interesting. Mainly it's certain investors who I think that they try to understand an industry and understand maybe if something's changing in it and those sorts of things. So like when Bill Miller and Buffett and some other people bought airlines, then that would make me look at that kind of thing. We don't really invest in airlines with the size of things we do, but that gets me interested in is something changing with that industry and that kind of thing. So there are some companies where like we could buy a smaller version that's not as well known and people are buying it, but it's more like for insights into maybe why would someone buy this thing that's outside of their normal sort of investment area that way. Yeah, definitely. It would be that rather than a particular stock. But I get sort of maybe industry ideas, I guess you could say that way.
I love reading other microcap or small cap investor fund letters. I read all of them. I mean, it goes up on Reddit. I'll look through and read them and stuff, but I don't know if I've ever gotten an idea from it.
Yeah, I don't know about that. I guess I've said that I've gotten ideas from like a message board or something like that, I guess. I think that's true.
Yes.
Got ideas from a blogger who didn't want something. Oh, recently I read something from a fund manager who sold something. And I was like, I'm going to take a closer look at this because his like reasons for selling it were interesting to me. So it sounded like the kind of thing I would buy. Yeah. Like his reasons for selling were like, oh, I might buy it then,
There was an idea that a company that we do own, that somebody laid out a thesis for why they weren't going to invest,
Right.
and to your point, what you just said, basically, it wasn't something that you would want to invest in it. So
Okay, the easiest ones are sort of the Charlie Munger says like invert thing. For whatever reason, the easiest seems to be when someone decides not to buy it, or they decide to sell it or whatever, and their reason seems wrong. Like it's easier. Maybe it's a contrarian thing or whatever, but it's easier for me to read something. It's hard for me to read something and agree with them, because for one thing, there's lots of things they might not be seeing that I'm not, but if they seem to have a good grasp of it and then pass, I'll give you an example. I won't name what blog it was and stuff, but Investors Title Insurance is a really good example. There's a write-up by someone a long time ago on it, and like their reason for whether they would buy it or not and everything. And it's kind of well, this probably isn't the best stock or whatever, but it might be good for a short time, like to own it and then I'll sell it, And they did make money on it on a short-term basis, plenty of money on a great annualized return probably. But it was interesting because you look at it and you're like, well, maybe you shouldn't sell it now when you like really think about it. I've said that about some, there was one stock where I read something that someone had done and I agreed with everything they said. And then they said, but it's not cheap, basically. Mm-hmm. And it was clear that it wasn't cheap compared to peers, I guess you could say. Like if we just call it whatever industry it's in, that's all, those exact peers, this same size. What they were doing is basically saying for companies in this industry that are this many $100 million, it's about in line on this ratio, on this multiple. But it's like way better than the other ones in it. So that's the kind of thing that is really attractive to me when I see that.
What gets me going is when I see a company, somebody lays out a great thesis for why a company is such a great business, and they say, but at these prices, maybe it's a little bit fairly valued.
Yes.
Maybe we should wait for a 20% pullback or something like that. Yeah, that's what I'm kind of like, oh yeah, like my lips are wet. Like this is great.
Yeah. So,
because we've talked about it so many times. There's some companies that are so great and you would love to own them if they got cheap.
Right.
And they just don't get cheap. They just continue to go up because they're great businesses and they continue to create value. My version of value is, I've thought about it a lot. It's like, what is value? Is value cheap, or is value something that's valuable? And those are two completely different things. Right. So I think if you're coming at it with the perspective of value is things that are valuable, you probably don't get too caught up in, well, I got to wait for a 20% pullback.
Well, I'll give you a great example. So I have gotten ideas for some things to talk about or to research or whatever from people, in the sense that like I read something about, someone had written up something about Monarch Cement. And basically they did a calculation and stuff and thought that it wasn't that cheap. Like they said, it has a moat or whatever, but it's not that cheap. But what was interesting about it is, I forget the exact thing that they had done, but basically they were like, well, you're kind of close to what the like historical, what it costs to put into it or whatever. And so I forget exactly what they said, but what they said basically was like, well, you could, they said like, so someone could basically build a cement plant for the same sort of price that the stock was at that time, which was a lot less. The stock was less than book, and that you're pretty close to it. And I kind of looked at that and thought, well, no, because the replacement value is different from the historical cost that they have, but also an acquirer should be very happy to pay at least replacement value. Because if you were going to build your own plant, you wouldn't do that. You would first go to the local company there and say, let me buy you, rather than have a plant competing with you. So in fact, you'd think that in an acquisition of a cement plant, it should go for some premium, or it should not go below the floor of replacement value. Obviously, replacement value is higher than the book value that's been that's not adjusted for inflation over that time. So that was a good example, but like that brought that to my attention. So there's a lot of, I've definitely learned about certain industries, business models, things like that by reading people, and their specific stock picks and what interests them about it, but not so much the actual stock. Even something like, in a sense, like, did I get the idea for like Virtu Motors or something from somebody? Technically, I guess no. I didn't like see it in someone's portfolio and buy it that way and stuff. But I had read things where people were investing in car dealers. I'd even read things where people were looking at car dealers in the UK at various times. So I was definitely thinking about those things. And if I hadn't read things where people analyzed and tried to value car dealers, then I definitely wouldn't have looked at it. You know, that's absolutely true.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us. Hit that subscribe button wherever you're listening to us. Follow me on Twitter at Focus Compound. That's the best place to get everything that we put out into the world. You can be on the lookout for any future Q&A call for questions where we can just go right and answer any questions that you have. You could also comment on this thread because we're going to answer more questions next week on this thread. So go to my Twitter at Focus Compound and post a question. I want to thank everybody so much for the support, and we will see you in the next podcast.